Welcome to the Insta Report. I'm here with Bill Bovingdon, Chief Investment Officer of Altius Asset Management, to speak about the Sustainable Bond Fund. Bill, welcome.
Thank you, Walter.
Can you tell us about the Sustainable Bond Fund and its objectives and why it was created?
Yeah, sure. Well, the Sustainable Bond Fund, in terms of why it was created, we did see an obvious gap in the market. There were alternatives for investors who wanted to invest on a sustainable basis in the equity markets, but not much for them in the bonds. So that's why we created the fund. In terms of its objective, we look to outperform both the RBA cash rate and also the Bloomberg Composite Bond Index by 1% over a cycle. So it has an absolute return flavour, which we think is important for investors given this stage of the cycle and how low interest rates are.
Yep. And can you tell us a little bit about the screening in the fund? What do you exclude explicitly?
Yeah, well look, the screen is designed to ensure that the borrowers in the fund are using their capital in a way which we think is responsible and sustainable. So the things that we explicitly look for and would disallow a borrower from accessing money from the fund are things like uranium, armaments, gambling, tobacco, pornography, and production of coal, and so forth. So they're the major, if you like, if the major activity of the company or a borrower is engaged in those, they're out. And then alternatively, in additional to that, we also have a number of sort of other elements we take into account which are more social issues. So looking at their human rights infringement performance, environmental performance, then looking at elements, other elements like the way in which they sort of meet their guidance or their overall governance requirements.
Yeah, and was that screen developed internally, and what sort of criteria were applied in making the assessment for exclusion?
Yeah, look, we put together the screen in conjunction with two of our cornerstone investors, yes. The Uniting Church Financial Services and Ethinvest. And the way in which the screen came together was, as I said, to assess companies against the criteria I mentioned earlier, but also to look at materiality. And to do that, we set up an actual advisory committee to look at individual cases and where the companies, because it can be a fine line, there are lots of shades of grey in this area. So that committee looks at the research of the companies and the investments that may go into the fund against the criteria that I've mentioned earlier, and we actually have two investor representatives on that committee, one from the Uniting Church and one from Ethinvest.
Okay, and we've seen a number of large super funds recently excluding tobacco investments. Do you see that as a start of a more broader acceptance of sustainable investing, or is it still a relative niche industry?
Look, I think it is the beginning. I still think at this stage it's relatively niche, and indeed, one can understand for instance, any superannuation funds or investment trusts that are related to the health industry would have a problem with tobacco, so that's an easy probably place to start. But we're finding that the investors who are interested in our fund want a broader assessment of what's a sustainable investment. So again, it seems to be building some momentum, particularly in the high net worth and in the charity sector, that they want to see that those their investments are actually doing good as well as earning good returns.
Yeah, and coming to those returns on the equity side, there's been a long debate about whether it impacts returns or whether it is good, beneficial for the returns. What are sort of the indications on the bond side? Yeah,
look, there isn't as much research in bonds, and I guess that's because it is a newer sector to apply these kind of sustainability screens. But I think one of the key things in bonds, and in particular in our case, is a recognition of the asymmetric risk in bonds. So there is no opportunity for an organisation to take risks and earn super market returns, which from an equity investor might be an attractive thing, even if they were sort of running close to the wind on environmental or social risks. With bonds, it's all about risk, because if you find that a company doesn't have a sustainability approach and culture, that they're likely to run foul of some of the guidance requirements. And from a risk management point of view, that puts the repayment of your principal as a bondholder at risk. So we see it a lot to really runs nice and close to our culture of risk management in bonds.
Yeah, excellent. Well, thank you very much.
Thanks very much, Walter.